You guys, I really thought that we were finally finding our footing with mortgage-backed securities. For the last couple of weeks, it's been a predictable tug of war between employment reports and inflation reports. And, I got a little excited, thought we were finally seeing the first signs of stability. And then Thursday, we got a better than expected CPI report, albeit just a minor improvement than expectations. And we saw some improvements in mortgage-backed securities. And then all of a sudden, towards the end of the day, we saw a huge sell-off that rolled into Friday. And we are now, as of August 14th, at the highest mortgage interest rates since November of 22. I'm not gonna say it's depressing, but it does suck the wind out of you if you work in real estate. And I imagine as a consumer, it's really scary, right? It's like, what am I gonna do if I am deciding whether or not to hold off and wait for better rates or to take, bite the bullet and buy now? And so I wanna break down in today's video my opinion on what the mortgage-backed securities market is looking for in hopes that it helps you guys make a better decision. Now, for those of you who are new to the channel, my name is Lizy Hoeffer. I'm a residential loan officer in Phoenix, Arizona, and I teach practical money tips so that people can make smart home purchases. So this week's kind of a big week because we have initial jobless claims and we also get to see the Fed meeting minutes. And this is really important because it gives you a really good outlook or an overview of the outlook for the economy, right? So who said what? Are there going to be any more Fed rate hikes? How do they feel about where inflation is moving? And do they still believe we're going to have a soft landing? And so based on the commentary in the Fed meeting minutes, that typically will move the market. Now, jobless claims are also really important because if we see any increases to unemployment, this also shows signs of economic weakening, and that's really what we're kind of hoping for. The economy has been rather resilient when it comes to the rising cost of goods and services, which is inflation, and the fact that unemployment hasn't really increased the way that you would expect it to because of the added burden to higher costs to businesses and banks. Like we would typically see higher unemployment in the past, and the fact is we're basically at capacity. So when we are looking for signs that there will be lower interest rates, we are looking for an increase in unemployment, and we'll have those answers, I believe, on Thursday of this week. So if I was a consumer and I heard this information, my first concern would be on home values. So whenever you hear that homes are not affordable, the number one thing that people hear is housing crash. Now, I will tell you that right now, in my personal opinion, based on the data that's available, 85% of people with a mortgage have a mortgage under 4%. And so their housing situations are actually cheaper than they would be if they were gonna sell their house or they had to foreclose for whatever reason. And a lot of people are sitting on, six figures in terms of equity. I think I read somewhere that the median equity for the United States was around $200,000. And so if that is true, it would make way more sense to sell your property. Now, right now, as of August 14th, 2023, there is enough demand of qualified buyers, even at these high interest rates, to buy the limited supply of homes that are available. And like I just explained, people with low interest rate mortgages don't want to sell right now. And so the inventory that's available today is based on people that have to sell because there was a death, a divorce, they're relocating, or they simply outgrew their properties. And there's a limited homes available for the number of people that want them, so it's still fairly competitive. Now, I will say that as somebody who works in real estate, when I look at the data, there's 40% of homes that are selling with seller concessions, and they're typically doing things like a 2-1 buy down, which is where the seller will temporarily buy down or subsidize lower mortgage payments for up to 3 years, depending on how you negotiate that. And that's making homes a lot more affordable for people that can qualify without a problem and are willing to bite the bullet now. And I will say that for those people that are willing to purchase in this market, they're finding a home with less competition. So my personal belief is, and based on the fact that when interest rates go down to low 6s, high 5s, a surplus of people on the sidelines right now, the estimations are somewhere between 3 and 5 million people that will re-enter the housing market when interest rates come down. When that happens, my belief is that demand will surge and home values will increase, Right now, the expectation is an increase of 6% for people who own a home in 2024. And that's just for right now with where inventory is today. And so if demand increases a lot, just realize that those home prices are gonna go up. And so you as the buyer have to look at why you're on the sidelines. Now, if you are on the sidelines because you want to get out of debt because the Fed funds rate increases have gotten your credit card debt into double digits. A lot of people have 15 to 20% credit cards right now. Yeah, I would absolutely concentrate on eliminating debt because it actually will expand your overall buying power in general, what you feel comfortable paying on a monthly basis. Absolutely, I would focus there. If you are concerned about your employment, I would absolutely hold off. If you are looking just for a better interest rate, this might be something to reconsider because even though you might get a lower interest rate, chances are you're going to be paying for a much more expensive house. And when we saw high demand like we saw in 2020 and 2021, just realize that people were paying over purchase price, over appraised value, and they were paying for all of their closing costs, plus allowing for rent back situations for their sellers. And so the cash needed to purchase in that market is way more substantial than the cash outlay needed in this market. So those are some things to consider. As for my long-term outlook on interest rates, I will say that for the foreseeable future, the next couple of weeks up to the next 6 months, I really feel like interest rates are going to be in the sevens. I think we will see, just like we've seen this, in the sevens, in the mid sixes, in the sevens, in the mid sixes. And depending on where you catch that wave is where you catch that wave. It's almost impossible to time the market. You have to buy when your budget is ready. And that's when you can save money, when you can pay down debt, and you're not compromising your lifestyle. And so if you meet that criteria and you understand that real estate is a long-term investment that also provides you the utility of living in your property, then I would say green light, buy, because your property is still appreciating and you are still getting that forced savings. But if you are somebody who is in debt, paying 15% interest rates, and you're stressed that now is the right time to buy, let me tell you, paying down your debt is going to give you way more bandwidth in terms of a buying budget than trying to buy and trying to squeeze it all in, right? That just compromises our overall health, adds stress, and puts you in a financial position that is very compromising. Like, we never want to be leveraged in debt more than we have savings and flexibility. That is my short-term outlook on interest rates. If you are somebody that bought with the idea that you would be refinancing, I want to let you know that the outlook is still that there is going to be lower interest rates. The fact of the matter is that everything they are doing to slow inflation will increase unemployment, will have a negative impact on the economy, and at some point, they will have to have Fed intervention to stimulate the economy, which is typically done through quantitative easing and the purchase of mortgage-backed securities, which will bring interest rates down. Now, it's very difficult to time when that will happen, but the likelihood of that happening is great. In fact, so great that you can see it in what's called an inverted yield curve, which is basically saying that short-term bonds are paying out at a greater percentage than long-term bonds because investors don't want to have their money tied up for the long haul because they believe that interest rates and bonds will be paying higher in the long run, meaning that interest rates will go down. And so because of that, I would say that there's a fair level of certainty that there will be a good time to refinance. And if you can utilize a strategy like a 2-1 buy down to help you pay lower mortgage payments in the short run, I would take advantage of that. And I wouldn't despair that you are now stuck with a 7% interest rate forever. But let's say that is your worst case scenario. Just know that you are buying a long-term investment. And if this is where interest rates land, I don't foresee real estate getting less and less expensive. I just think that we will all acquiesce to different types of loan products, and there will still be an opportunity for you to get a lower payment in the future because there will be more creative lending products that roll out. So let me know what questions you guys have in the comments below. I love to answer them, and any future video ideas you'd like for me to tackle. Guys, don't forget to like, comment, and subscribe, and forward this video on to friends or family that you think could use this valuable information. So until next time, guys.